Hey everyone, I'm Sarah. I'm going to be taking you through the SWOT analysis and then get into the organizational financials. Starting with strengths, Gemini runs a really efficient operation with highly automated production. They use just-in-time manufacturing, which helps keep their inventory low and gets products to their retailers faster. Their operational margins are strong compared to the industry averages. They have significant cash reserves that give them the flexibility to grow. On top of that, they have a strong research and development or R&D team that's driving their innovation, which improves their access to capital from investors. That's always great for funding new projects. Moving on to weaknesses, the company does rely a lot on their debt financing. A lot of cash is tied up in accounts receivable or AR and in inventory. Most of the revenue still comes from TVs, so they have they're a bit overly dependent on one product line. They have limited negotiation power with the retailers as well because their brand isn't very well known yet since they're still relatively new. The speed of innovation in the industry is a real challenge because they need to keep up with the changing technology, and it's very easy to be outpaced in the tech world right now. Let's talk about opportunities. There's a few clear ones. Gemini could expand into smart TVs and 3D TVs. Of course, this is keeping in line with their one main product. They could also grow through selective acquisitions, and by that I mean they'd be buying smaller companies that complement their current products. The idea basically is to be strategic and pick acquisitions that fit well with what Gemini already does. They could also gradually expand geographically as they strengthen their relationships with their retailers. There's a few other ways to grow as well, expanding complementary product lines like maybe sound bars or home theater systems. Connectivity, accessories, and other items could bring in more revenue without moving too far from their core products that they already create. Using e-commerce or direct-to-consumer channels would open up new markets and improve their margins because they'd be going directly to the consumer instead of the middleman with the retailer. Another option could also be partnering with another U.S. company, U.S.-based company or U.S. manufacturer or whatever to help avoid tariffs, and that's a big issue everyone's dealing with right now. A lot of the bigger competitors are having to deal with that, and that could help keep their costs down also while they're expanding. Finally, let's go over the threat section of the SWOT analysis. The industry is very competitive, so price competition is always a risk. Technology changes quickly, which means products become outdated really quickly and puts pressure on the R&D team. Retailers have a lot of bargaining power, again, because the brand name's not very well recognized yet, which can affect the company's cash flow, and ongoing price competition can squeeze their margins. Gemini does most of its manufacturing in the US, but they do still source some of their components from other countries, so tariffs and trade policy changes remain a risk that could increase their costs. Let's see. Now that we've gone through the SWOT analysis, let's look at the financial health of Gemini. I'm going to cover liquidity, asset management, long-term debt, and profitability, and what those numbers mean for the company's potential growth. Liquidity ratios show whether a company can cover their short-term obligations. Gemini's current and quick ratios do indicate they have enough working capital for immediate needs. That's important because as they grow, they'll need cash for production, new product launches, potential acquisitions, and so on. Healthy liquidity also gives them the flexibility to respond to supply chain disruptions responsibly, especially since some components are coming from outside of the US. Moving on to asset management, ratios like inventory turnover, receivables turnover, they show how well Gemini uses resources to generate their revenue. The numbers suggest inventory and receivables are managed efficiently, although some cash is tied up due to generous credit terms with the retailers. Again, that goes back to how well their brand is known. This is expected for a company that's in this early growth phase. Efficient asset use is key if they want to scale globally because it's going to let them generate revenue without locking up too much capital, and it helps them reduce waste. Debt ratios like debt to equity measure the ability to manage long-term obligations. Gemini relies on financing more than the industry average, but they generate enough operating income to comfortably cover their interest payments. As they expand, whether they do that through new products, acquisitions, entering new markets, whatever, they'll need to balance the debt and retain earnings very carefully. Taking on too much risk could be very dangerous, especially if tariffs or global market conditions change. Profitability ratios like net profit margin, return on assets, return on equity show that Gemini has performed well historically with strong margins due to efficient operations and scale. However, margins have started to decline recently because of price competition and the cost of growth initiatives. Profitability is still critical because it funds R&D, product innovations, sustainable growth, whether that's acquisitions or anything else. And by continuing to innovate in TVs and home entertainment while keeping production efficient, Gemini can stay competitive globally without cutting corners. Overall, Gemini's financial ratios shows that the company is in a solid position to grow. There are risks to watch, especially around the debt levels and cash tied up in receivables. So paying attention to efficiency, profitability, and liquidity is going to be critical as they expand product lines, maybe enter new markets, or pursue strategic acquisitions. Next, Shantara is going to go over our recommendations for Gemini.